What is up, Hot Take Nation? It is DRW here, coming to you on the week of February 12th for the Hot Take over your commute. To be honest, I really want to be jacked up and excited and happy and tell some jokes. And I mean, last week was just incredibly brutal. It was brutal in every way that you could imagine. Friday, stock market got killed. Not that matters, but I really think that this could be the turning point. People have been looking for a pullback. Markets go up and down. But you can think about the Democratic primaries, and Bernie Sanders is surging in Iowa. I don't think anyone really gave him a serious shot at winning the presidency. This isn't about who should win or who you pick, Democrat or Republican. This is 100% that it's hard to imagine the change in the economic policy in the United States in terms of Medicare for all, taxes, wealth taxes, redistribution of wealth. I've seen people predict, and who knows these things, but 25% stock market crash on like an Elizabeth Warren or Bernie Sanders winning. That is terrifying. So even though we're going to start with the coronavirus, because worldwide panic, and I guess that's to be expected. If you don't panic and it turns out to be bigger, then everyone looks like an idiot. Everyone loses their jobs. Companies get sued. Everyone blames the world. But to me, I still come back to, we talked about it last week. So far in a month, 200 people have died worldwide, and the flu kills 700 Americans a day. So it's been 30 days. 21,000 Americans would be dead from the influenza. 200 in the world are dead from the coronavirus. It's not cool. It's just not that big a deal. So I'm not really looking to the coronavirus as something that I'm worried about. I could be wrong. I'm not. That being said, it doesn't matter what I'm worried about. What does matter is that oil has moved from 63 January 2nd after an Iranian general was killed with a U.S. missile. And here we sit February 2nd, and oil is 51. Gas is $1.80. Waha gas in the Permian Basin is basically zero. And we've talked about this before. I don't want to belabor the point, but our business does not work at $51 a barrel and $1.80 an MCF. It does not work. So this week we're going to start with Jim Cramer on Friday. He came out and in his infinite wisdom, after seeing Chevron and Exxon's earnings, which both missed estimates and therefore were down, and they were brought down by the general malaise of the market. So hard to say that it was just the earnings. Chevron had obviously pre-announced the natural gas write-down in their Appalachia region of about $10.5–11 billion. So no surprise there. But Jim Cramer said it is the new money managers they're rejecting fossil fuels and they're just selling. So it doesn't matter what we do; they're just selling. I just don't think that that's right. I've said this before. I'll say it again. I still believe that most U.S. E&P stocks are overvalued. We are not a multiple business. We have an asset that produces wells that we know the cost of, we know the LOE of, we know the royalty of, we know the development place. We do a reserve report, and if you didn't catch it, you should. Todd Brooker from Collie Gillespie was on this week on the podcast talking about reserves, SEC reserves, talking smog. It does a really good introductory dive, I think, into reserves and why they matter. But at the end of the day, if you have 10,000 acres and you have 100 wells, you're going to drill 100 wells, you know what they're worth, and you're going to go drill them. That is not a multiple business. That is an NAV business. And still, our companies are not trading at their NAV. I would say that most of them are trading above their NAV, or if they're trading below their NAV, it's because their balance sheets have more than 3 times debt to EBITDA. And we've spent a lot of time talking on that. So I don't want to talk about that this week. But this isn't a fossil fuel problem. This is a business problem. And what I'm going to be really interested to see over the next month is who is going to be brave enough to say, look, oil's $51. I'm going to complete the DUCs that I have, but I'm going to release my rigs. Every rig I have, I'm going to release it, because me investing new capital, I am not getting a rate of return that matches the rate of return that I need. So I'm going to complete my DUCs to kind of hang in production, and half cycle economics are pretty good. I'm going to use all of the surplus debt to pay down my debt. And oh, by the way, if my debt is trading at a discount to par, so we don't spend a lot of time on bonds. Certainly, the stock market gets all the love, but the bond market is much, much bigger. Bonds are pretty indicative of when you're having financial crisis. So a bond should trade at 100 cents on the dollar. And so if you have a 6% coupon rate, 100 cents, there's your 6% interest rate. When investors think that company is going to go bankrupt or has a high risk of bankruptcy, that bond is going to trade down from 100 cents to, let's say, 65 cents or 63 cents. So they still pay 6 cents, but 6 cents on 63 versus 6 cents on 100. Now we're talking like a 10, 11% interest rate. Now, what can a company do? Maybe work with their revolver and borrow money against their revolver and go buy out 100 cents of debt for 63 cents, two birds with one stone. Yeah, you've added some debt, but you've recapitalized your RBL, which has a lower interest rate than the face rate on your actual bonds. And so, yes, you tighten your liquidity, but if you can get rid of 100 cents of debt by only paying 63 cents, what do you think would happen to those bonds generally? They would say you're less risky at going bankrupt. Therefore, what's going to happen? I'm going to say your stock's going to go up. And if your stock goes up, much like what happened with Tesla over the last week where it exceeded $600 a share, how silly does it look that everyone was mad when Elon tweeted, about a year ago, 420 funding secured, and now we're well over $600. And a lot of the things that's been driving that, at least if you believe the commentary, is the short sellers have been squeezed where the more it goes up, the more they have to cover. The more it goes up, the more they have to cover. So for some of these names in E&P that have just been absolutely beat down by short selling because, quite frankly, their balance sheet sucks, maybe they should be doing some debt to equity conversions or some RBL use if they have some capacity and go buy out some cheap debt. Fix their balance sheet that way, because make no mistake, at $51 and $1.80, there is no economics in the things that we're doing in the U.S. You cannot be investing new dollars. We talk a lot about firm transport and the perverse incentives and the prisoner's dilemma of if you let your production decline, your debt to EBITDA goes up. Your banks could potentially force you to restructure. You go to Chapter 11 and you're dead. So you keep your rigs up, you keep your production up. But with declining prices, your debt to EBITDA is already screwed, guys. Let's just stop. $51 a barrel does not work. $1.80, yeah, I get that you have firm transport, but I'm going to use the U.S. one. There's 12.8 million barrels a day. The EIA 914 report, if you haven't looked at it, just pull it up. 12.8 million barrels a day. About 3.8 million barrels a day is produced from wells that came on in 2019. So in the last 365 days, 30% of the oil being produced in the United States is from wells that came on a year ago. As a nation, if we were a country, that sort of implies a 30% base decline. That's conventional, unconventional, etc. We know unconventional plays are steeper. So I get it. You have 100 cents of cash flow. You don't spend any money. You're going to 70 cents. If you have 3 times debt to EBITDA, your 3 to 1 is going to 3 to 0.7, so your debt to EBITDA goes to 4.5. But just announce, it's time to do some strategic alternatives, kids. That's what Uncle David is saying. We need strategic alternatives. We need to start merging. This is not an option. And you would have seen I came out and called one of my stocks, CDEV. It was not them that blocked me, in case you're curious. I called and said, look, I have more shares than most of your non-executive. In fact, all that's reported, all of your non-executive board members own less shares than I do personally. So I'm very invested in seeing CDEV do the right thing. I think that they need to sell. I think they need to sell for equity, and I think that they will be a stronger company by doing so. And I appreciate that they didn't block me for saying that. They respect as a shareholder, I have the right to say that. That's what I believe. They are one of many, many companies that need to merge. And so I will give some credit, because one of the things that's made it sticky, and this is not about any company in particular, executive compensation. Management teams want to continue to draw salaries that mergers may not allow them to do. I will give Oasis, even though there wasn't a lot of details, I will give Oasis some credit for addressing the executive compensation issue and highlighting that they are lowering executive comp and changing the target structure. it would be good in the press release if they actually said exactly to what instead of putting it in a proxy for later. But let's just ignore that because I think it raises an excellent point on executive compensation. If the senior leaders who are driving the strategic direction of the company and the board members who are driving the strategic direction of the company were forced to take all of their comp or virtually all of their comp in stock, common stock, not options, that is their payment, and 90% of their income came from the stock, do you think that they would be more or less aligned with shareholders when they thought that they could make the stock go up? I'm going to go with more than for 200, Alex. So I am excited to see that Oasis is addressing this, but I think we need to go much further, which is at this point in the cycle, I'm going to say every leadership team should take nothing but equity in their company instead of salary. It reduces the cash burden, and it much, much, much more greatly aligns the leadership. And I'm telling you what, two companies coming together, saving G&A, not having to drill, getting a better balance sheet, all of these things are going to make the company stronger and make it possible for them to survive. And if that company survives and they can get their debt under control and oil moves back to a place that makes sense and gas moves back to a place that makes sense because supply demand will eventually take over, then those companies get healthy and those stocks go up and everybody wins. So that is the week, really. Nothing more to report. You may have seen, last thing, the artist formerly known as Encana came out with their Anadarko Basin Investor Day presentation. And you know that I desperately want to dig into this and do a Technical Tuesday. But I want to do a much deeper one because what I will give credit to Encana and Newfield for doing is they recognized they needed to come together as two companies to consolidate costs. When I see their Q4 earnings and their year-end annual report come out later in February, we'll be able to actually assess what did they accomplish and not what they put in the investor slides, because anyone can put anything in when you have a slide 2 that says forward-looking statements. None of this should be used for investment advice effectively. Read one of those, they're terrifying. But I do trust what comes out in the annual report. I do trust the financials. I do trust the reserve report. So I want to see year over year what has been the change from Encana and Newfield coming together, and how is this a good template for other companies coming together? So look for that at the end of the month in February. Until then, there's going to be a couple weeks of some pretty heavy reporting. We're going to try and hit all the highlights. In the meantime, throw a bucket on your head, grab a mask, stay away from people that just came over from Wuhan. Be safe, be good. Have a great week. You can follow us on the web at www.hottakeoftheday.com. You can catch up on all our old podcasts, posts, and as always, you can email me anytime. Have a great week. Thanks for joining us. Bye for now.